We are in the early innings of earnings season. Next week, UnitedHealth is going to report their earnings on Tuesday. And we're going to take a look at UnitedHealth and some of its competitors to see if we can find some steal deals in those companies before they report their earnings. Now, we are looking at a 3-year chart here, and we can see that if you had invested in the S&P 500, you would be up 81% in that time. However, if you had invested in any of these other healthcare companies, Humana, UnitedHealth, Cigna, and Elevance, you are down. As a matter of fact, Humana is down 44.63%. And so the healthcare space has not been a good place to be in with your money in the past 3 years. If we look at the past year, we can see that that devastation has been local, has been immediate, 15.07% in the S&P 500. And if you had invested in UnitedHealth a year ago, you'd be down almost 30%. What we're seeing, though, is if we look in the past month, UnitedHealth is making a comeback. It is up almost 10% in the past month, and the others are following behind a little bit. But VU, the S&P 500, is at the bottom. So the question is, can we capture some of that before healthcare stocks overtake the rest of the market and really start to see some gains? Just a quick reminder, if you get anything out of this video, please like this video, please subscribe to the channel, tell your friends, tell your family, tell your mother-in-law about this channel. We're building out the Interflame Finance family. We love serving you and we love reporting on these companies. Now, if you are new to this channel, what we do is we score companies on a scale of -10 to +10. -10 is an absolute garbage company. +10 is the perfect company. And what we do is we do that on growth and we do that on safety bases. And so, for example, if we look at Cigna here, we can see that their PEG ratio is 1.12. Remember, we like PEG ratios to come in under 2. That's fantastic. And the lower, the better. And so we really want those to be under 1. Sigma coming in at a very decent 1.12. Their forward PE is coming in at 9.16, and their 5-year forward PE, if they can grow about 16% a year, is going to come in at 5.88. Free cash flow yield, we want that to typically be above 7%. We see Cigna is coming in at 9.97%. So strong growth metrics for Cigna. Forward PE for Elevance is about 14. PEG ratio way, way, way higher than we want it to be at 15.53. Debt to equity coming in at 0.73. That's very good. Profit margins coming in solid at 2.84%. And what I mean by solid is relative to the other companies that we're looking at, that's one of the best. A 5-year forward PE coming in at 11.26. So if they can grow 6.15% each year, then we will hopefully see that forward PE come down in the next 5 years. Humana, debt to equity 0.69. That's the lowest of all the companies that we're going to look at today. PEG ratio, not too fantastic, not a lot of growth relative to where they need to be in terms of their price to earnings at a 2.63. But remember, we want that to be under 2. Revenue growth coming in at 9.01%, EPS growth coming in at 15.5%. And finally, UnitedHealth, the star of the show, the company that is reporting its earnings next week on Tuesday. Return on equity coming in at 18%, return on invested capital 11%, profit margins, the best of these 4 companies at 4%, revenue growth 6.61%, and free cash flow yield coming in at 5.38%. So not the strongest numbers for these companies. We couldn't get a solid PEG ratio for UnitedHealth. Nothing too reliable that we wanted to report here, and so we left that blank. And we did ignore the other PEG ratios for the other companies because of that. Now, when it comes down to their growth scores, we see that Cigna comes in at 5.56. We see that UnitedHealth comes in at just a 3.8. We see that Humana comes in at a 2.5, and finally Elevance comes in just at a 1.9. Now, a 0 score would be a neutral sentiment, and so what we typically do is we want to choose companies that have scores of 5 and higher. So really, based on growth metrics, the only company that we would really consider is Cigna. Now, because these are very large companies and they all pay dividends, we want to make sure that we also look at their safety metrics. And so Cigna comes in with a PE ratio at 12.33. They're currently paying a 2.34% dividend yield. They have grown their dividends 7.86%, and they have grown that for 5 consecutive years. So that's fantastic. Payout ratio, 36%. That's pretty decent. We want to see that. That gives us confidence that they can keep continuing to pay out those dividends and possibly grow those dividends. Elevance, a dividend yield of 1.83%. They have grown their dividends for 15 consecutive years. They have grown them recently 4.91%. Payout ratio, fantastic at about a 27%. So Elevance can also probably continue its dividend payments. Humana, dividend yield 1.37%. No data on dividend growth or years of dividend growth. However, they do have a solid payout ratio of 34.3%. And again, the star of the show, UnitedHealth. We see that their dividend growth is 6.72%. They're currently offering a 2.45% dividend yield, growing their dividends for 16 consecutive years. Now, the payout ratio is encroaching on 50%, so that does make us a little nervous, but it's not astronomically high. So hopefully they can continue these dividend payments. So when it comes to safety, UnitedHealth is at the top at a 6.9. Tied for first place is Cigna also at a 6.9. Humana comes in at a 4.4. And finally, Elevance comes in at a 3.8. Now, before we get into our own price predictions, we're going to look at what the analysts have to say. Cigna is coming in at an average price of $353 this time next year. That would imply a high 20s to low 30% growth from its current price point at $279. The low estimate's coming in at $294, and the high estimate is coming in at $390. So, strong buy rating from the analysts from stockanalysis.com. And again, we see pretty decent growth expected for this year in Cigna's stock price. Elevance coming in at just a buy. We see that the average growth for Elevance in the next year is about 6 to 7%. High growth estimate coming in at $485 per share, so that would be about a 31% upside from here. And some analysts think that the price is actually going to go down. It's currently trading for $371. Some analysts think it's going to go down to $297. Now, UnitedHealth, also the low estimates coming in quite low at 198. That's why we see just the buy rating from the analysts. However, the average estimate is about a 12% upside from its current stock price at 356, and the high price prediction coming in at 575. That would be a 61% growth from its current stock price. And finally, Humana. Analysts just coming in over a buy for Humana. We see about a 9% average upside in the price predictions for Humana. Some analysts think that it's going to go down to 231. That would be a 13% drop from its current price point. Some analysts think, the most bullish of them, think that it's coming in at $345. That would be just under a 30% upside from here. So now that we know what Wall Street thinks, what do we think at Interflame Finance? We are going to compute intrinsic values. If you don't know how to compute intrinsic values, check out the description of this video. You'll see 4 links on how to compute 4 different intrinsic values. These are absolutely crucial, necessary tools that every investor needs in their toolbox to predict not what the stock price is, but what it should be. And are we getting these companies at a bargain price? And so what we're going to do is we're going to look at the average scores of each company. For example, here's Elevance. The growth score came in at just a 1.9. The safety score came in at just a 3.8. We average those two scores together and we get a 2.85. Not the strongest score. Again, we typically want scores 5 and higher to make sure that we are selecting and investing in quality companies. The intrinsic value that we came up with for Elevance is $420 per share. They're currently trading for $371 at the time of recording this video, and that would imply a margin of safety of about 12%. Now, we like margins of safety to typically be 20% or higher unless we have very, very strong conviction in these companies. So for Elevance, nothing too terribly exciting coming in for these numbers. If we wanted to buy and get a 15% discount, then we would start buying Elevance at $357. And we would buy very heavy if it gets $273 or lower. So for right now, Elevance, not too terribly attractive, but please keep in mind that nothing that we say on this channel is financial advice. We are not telling you to buy, hold, or sell anything in your portfolio. Always do your own research, always do your own due diligence, and make sure you are making the right choice for your portfolio. Everything on this channel is for educational and entertainment purposes only. Now, second place is Humana. They're coming in with an average score of 3.45. They do have a better margin of safety, over 20%, like we like to see at 21.6%. But again, their average score is not coming in too terribly fantastic. Current stock price is $267. Intrinsically, we think that it is worth $340. And so if this is something that we wanted to buy, we would buy any price under $289, and we would buy much more heavily if it ever got down to $221 or lower. Next comes UnitedHealth. Now, they do have an average score above 5. We like to see that at 5.53. Intrinsically, we think that UnitedHealth should be trading for $525. The current stock price is $356, so that implies a 32% margin of safety. Now, we would buy UnitedHealth, given that data, at $446 or lower, and we would buy much more heavily at $341. So if earnings come in next week for UnitedHealth and they don't meet expectations and it just beats down the stock price, well, if it got below $341, we would not only be buying UnitedHealth at Interflame Finance, but we would possibly consider buying much more heavily if the numbers didn't look too terribly bad. And finally, Cigna. They have the highest score of these four companies at 6.25. Again, not too terribly strong, but they do come in with growth and safety above 5. Their current stock price is $279. Intrinsically, we think that they are worth $450. That gives us a fantastic 38% margin of safety. If we wanted to buy this company, we would consider buying it for anything under $383, and we would buy much more heavily at $293 or lower. Now, the current stock price is $279. So of these four companies, if we had to choose one, Cigna seems to be the way to go. It has the largest margin of safety, and it has the highest score. So there you have it. There are some healthcare stocks for your portfolio coming in with Q4 earnings for 2025. Going into 2026, the healthcare sector has been beaten down horribly. All the companies have seen massive, massive drops. And so maybe this is the time to capitalize. It really depends on what's coming out with earnings and what we see in the conference calls and in the numbers. As always, do your own research and your own due diligence when you're investing in any of your hard-earned money into any of these companies. Please like the video and subscribe to the channel if you got anything out of this video. We appreciate you being here, and we'll see you on the next video.